Hello, welcome again. So in this lesson, we will learn how to prepare the journal entries and then post to the ledger accounts and prepare the unadjusted trial balance. So let's get started. So the first one, so we have the problem here. Say, so Halogen Laminated Products Company began business on January 1st, 2022. So during the month, the company has occurred the following transactions. Okay. So the first one issued common stock in exchange for 100,000 cash. So what should we do? So we have basic cash. Cash is debit and common stock credit, right? So that is 100,000. Okay. So second one, purchased inventory on account for 35,000. So the perpetual inventory system is used. So what should we do? So we have purchase inventory. So inventory debit and since it is saying so on account, so accounts payable, okay, accounts payable credit. So 35,000, sorry, it is 35,000 and 35,000. Okay. Now then January 4. So they paid an insurance company 2,400 for a 1 year insurance policy. Okay. So what we have done, prepaid insurance and cash, because we have created an asset and the name of the asset is prepaid insurance. So that is 2,400 and then sold merchandise on account for 12,000. The cost of the merchandise was 7,000. As we know, we have to prepare two journal entries. The first one is for the sales. So since the customer didn't pay, so we have to record the accounts receivable, right? Accounts receivable debit. So that is 12,000 and sales revenue credit. So sales revenue credit 12,000. And you know that the cost of the goods we have sold was 7,000. So it is, so cost of goods sold 7,000 and inventory has been decreased by the sale. So inventory credit. Okay. And January 15, we have borrowed 30,000 from a local bank and signed a note. Okay. So in 6 months, we have to pay the interest. So we don't need to care about the interest now. So what we will do, so we have received cash and the cash amount is 30,000, right? And then we will record the credit of note payable. So the credit of note payable is there. So January 20, paid employees, 6,000 salaries and wages. Okay, so salaries and wages expense. Okay, salaries and wages expense is 6,000 debit and we have paid in cash. So cash is credit. Okay, and then again, we sold merchandise on January 22nd. And let's see. Oh, it is in cash. So it is in cash. Uh, so cash is 10,000 and sales revenue is 10,000. And definitely we have to record the cost of goods sold. And the cost of goods sold was 6,000. So cost of goods sold is 6,000. And definitely the credit would be inventory, correct? So January 24, we paid 15,000 to suppliers for merchandise purchased on January 2nd. So on January 2nd, we purchased merchandise on account for $35,000. So we recorded accounts payable. Since we are paying, so accounts payable would be debit. Now, how much we have paid? 15,000 we have paid. And definitely, since we have paid, so cash is going out, cash credit. And January 26 collected 6,000 on account from customers. So meaning we have collected cash. So cash is debit and accounts receivable credit. So because we are receiving money from the accounts receivable, so it will decrease by the collection of the money. And January 28 paid 1,000 to the local utility company for January gas and electricity. So what we do, we will be recording the utilities expense debit. So the utilities expense debit is 1,000, and since we have paid in cash, okay, so it is cash is credit. And on January 30, so paid 4,000 rent for the building. Look at this. So 2,000 was paid for January and 2,000 was paid for February. So we are recording on January 30. So what should we do now? Say that. So the first one is $2,000 is for the January. It is an expense. So rent expense debit, that is $2,000. And since we are paying for February as well, so that should be our prepaid rent, correct? And prepaid rent debit. And we paid the entire amount in cash. So cash is credit. Okay.